Okay, so now we get to step number 4, which is that you should know the 10-day ATR and be aware of the general volume environment. Okay, and again, this step is related to step number 3 because this is all about market volatility and the size of the daily ranges. This is very important stuff. We've already discussed it before in the initial foundational training, but now we're just going to go on a bit more practical level and see how to integrate that with the rest of the steps that came before it to give you a better picture of what's likely to happen on this current day that you're about to trade. So let's jump right into the charts to do that. Alright, so here we are on the chart, and what we're looking at is the average true range indicator for the ES, the S&P 500. Alright, and as we see, the 10-day ATR is right now at 16.75. This means that the average range of the last 10 days is about 16.75 points. And the way to get this indicator, you have to have a daily chart of the market, i.e. daily bars, and then put this indicator, either overlay it on top of that or below it. Right here, let me show you. I have it actually underneath this chart that we were putting in the lines for, and it's a daily chart. And when you have a daily chart, you get daily ATR. If this was a 5-minute chart, I would be getting the average true range of 5 minutes. Let me just show you real quick. Okay, so I've switched it to a 5-minute chart, right, which is what we were looking at before, and now I see it's only 2 points. This is telling me that the average range of a 5-minute bar for the last 10 5-minute bars is 2 points. Okay, and this is helpful too. I mean, you can look at this intraday and see what the volatility is like. Some days will be quite volatile and you'll have high average true range, and it helps to look at this and compare it to the previous days and just see what kind of volatility you're getting this day versus the last day. And if you're getting good volatility early on, that could be a good thing. So you can look at this on any time frame, right? But for the purposes of gauging the general volatility environment in the big picture, we look at a daily chart. So let's go back to that. All right, here we are back to that. Let me just now expand this and just show you just the ATR again. Okay, so we see that the average true range is 16.75. Now when you're looking at the daily, this is naturally going to include the overnight trading too. So it's going to be the combined range, the 24-hour range of each day, not just the day session. If you're a good programmer, you could program an indicator that just shows you just the day session. Oh, there's probably already some out there that are programmed. But the point of this, right, why do we actually look at this? Well, think about this. If you're trading this current day, and just like we were doing before, we did a top-down analysis, right? And then we drew in all the key reference areas. Then we checked out the economic calendar to see if we were going to have volatility or not. But what does having volatility or not having volatility mean? How large is a volatile day and how small is a quiet day? Well, this is what tells you. This tells you that the typical day right now is about 16.75 points when you look at the whole range between the overnight session and the day session. Okay, so if we're expecting a normal day, maybe the economic calendar, has one market moving thing, not too big, then you can expect it to be somewhere around here. It won't be exactly 16, but just somewhere in the range of that. Okay? And once it gets to somewhere in the range of that, you're usually reaching the limits of what it'll likely be. So if it's already moved 16 points and there's nothing else in the market that's showing that it's going to be some massive trending day, well, it probably doesn't make too much sense to be entering a trade in that direction looking for much more. Okay, unless there's some other contextual things that tell you can be having a breakout move. in which case volatility would rise. Like here, we see this massive rise. Well, this didn't take place on one day. This was a several day period in which the market was just getting killed. And let me actually show you that. Okay, look, this was when there was a huge meltdown all the way from about 1320 in the S&P down to 1050. Okay, that's about a 20% drop in the index. And when you have those massive drops, fear kicks in, panic kicks in, and you get this big volatility. So that's what was happening there. And if you were trading in this period, right, a normal day at that point might be 35 points. Okay? And so you look at the ATR and you can gauge what would represent a normal day. And of course, when you have a 35 point day, now when you're entering the market, your stops aren't going to be tiny 2-point stops. You might have to widen them to 3 or 4-point stops so you don't just get shaken out by noise. And your profit exits aren't going to be tiny 3 or 4-point profit exits. They're going to be needed to be wider to adjust for the volatility. You understand how this works? The context and the economic environment tells you whether we're likely to have volatile or slow days. But then this, the ATR, tells you how much. What kind of range should I expect? What is average? What is above average? What is big? What is small? Right? It gives you an actual number as a guideline. Nothing's going to be exact. Even if you have high volatility, you can have a really quiet day, or if you have quiet volatility, you can have a really volatile day. That is affected by the context, but most of the time, this will really help you gauge how far in each direction the market's likely to move on a particular day, and that's huge. For day trading, that is huge. Most traders don't understand how important it is to be always gauging the likely volatility, because the context could tell you something, and you could see a great buying point, for example, and you think there's going to be a big breakout move, and you jump in and expect a 15-point move, and you have a 3-point stop, and you're thinking, okay, that's 5-1, that's great. But the problem is, the economic calendar could be light, there could be nothing happening, and then the average true range could be something like here, where it was like 10. So yeah, the context may look on the charts like it's good, but you're unlikely to probably be getting the move you expect on that particular day, right? It's always all about timing. You can be right about your analysis, you can be right about the context and everything. Doesn't mean though it's going to play out that day. And when you're day trading, how else are you going to make money unless you take advantage of what plays out that day? It's not just about the general picture, right? And so understanding the economic calendar and the actual average to range will help you gauge and guide your expectations into how big of a move we are likely to get. And that's going to make all the difference in your trading. It's that big. As the ATR goes down, on average, your stops are going to get tighter and your profit exits are going to get less. Okay, you see how it affects that. As volatility really goes up, like here, your stops are naturally going to get wider because there's just more noise in the market. Now a 4-point move can easily happen without meaning much. So you don't want to have these tiny 2-point stops that are just going to get hit randomly, right? And now, a 6 or 7-point exit isn't that big. That happens in a matter of minutes. So you need to shoot for more. And because your stop is wider, you have to shoot for more to have the large reward to risk. So volatility and being able to gauge volatility is huge. It's one key skill that you have to form, and you have to keep track of this every day. Other than the economic calendar, you have to be looking at the ATR, gauging what likely moves to expect. Most traders, once again, are just looking at little patterns on the charts, looking at their candlestick formations, looking at the technical stuff they've been taught, and then just trading that without realizing that there's this whole aspect of volatility and the gauging of potential ranges that comes into play for you to actually be able to take advantage of moves in a timely manner and to know when they're more likely to happen. Okay, it's not just about analyzing the context once again. And so the other thing that'll help us gauge this is also volume, which I had discussed in the early training, but let's just jump right back into that quickly and show how it applies on a day-to-day basis. Alright, I've now switched the bottom pane to volume, and this one's a more kind of vague or general indication. You just want to glance at it. It's not an exact thing like an ATR. But what you want to do is gauge the volume environment. And when it comes to strategy and developing your trade plan, you want to look at the general volume, but then later when we get into tactics, the intraday volume is actually going to be important on a comparative level. And we'll get into that later. But for now, what you want to do is just kind of glance and see, over the last few days or couple weeks, what kind of volume environment have we been in? Okay, let's just zoom in a bit here and see. All right, so for instance, when you're like here, you see this volume environment over these few days is just less than everything around it. So look how tiny the ranges are. Volume affects directly volatility. It's really the main determinant of volatility. You see, the economic news and all that causes big moves, right? Because that's when the institutions come into play. But the only reason that those big moves are caused is because of the big volume that those institutions bring in with them. And the more orders they have and the more volume, the more directional movement can take place, and that's why volume correlates so much with volatility. So anyway, this is just a general thing to be aware of, nothing exact here, and you'll get more into trouble trying to be exact with volume than probably anything else that I've found in trading. It's just a very subtle thing, but just have an idea. If you're seeing just really low volume days, right, most likely you're in a sideways tight quiet environment, and the ATR will confirm that. It's all these things confirm each other. But then if you have a day where it just has really big volume, that could be the start of a bigger volatility environment, or it could be just a one-time thing. But it's good to keep a heads up on that. Right? Summer months, like this was August, summer months usually have really low volume, so the trading is quiet. And the months where we have earnings come out, January, April, July, October, those months usually have higher volume and correspondingly higher volatility. So just understand this general relationship, even though on this basic level it's not going to be anything more than just a general gauge that you're aware of. When we get into the tactics and the intraday stuff, understanding engaging the volume as it happens intraday is actually quite important and will tell you a lot. Okay, but I wanted to make sure that you understood it first on a strategy level, understood the correlation between volume and volatility, so that once we get into that, it makes sense to you. And it's always important just to have general awareness of volume every day, just every day before the market starts. Just take a look at what the volume has been doing the last few days. Has there been any major rise? Has it just suddenly dropped? And that'll guide you a bit more going forward. All right. So anyway, that basically wraps up this fourth step. And in the next session, we'll move on to the fifth one.